Hello, hi everyone. Welcome to Bullet MCQ session SFM. So, I have worked for almost 4 to 5 days, okay, to save your time because I have already explained MCQs and around 10 hours duration class was uploaded in app, okay, in our BCCA app, okay. But now, after that, so to help you on day before examination, I have worked a lot and I have eliminated all the repeated questions. And from examination point of view, I'm giving a set of questions, MCQs, and these MCQs are not, I mean, more than 200 also. They are less than 200. So they are around 150 to 200. I have explained the MCQs in this video chapter wise and I thought of to come live, but if I come to live, students will be asking doubts and questions that might waste time. So that's why I've recorded MCQs. Okay. But if you have any doubt regarding any MCQ or preparation, okay, right now I'm going to tell you about the preparation strategy also. But even then, if you have any doubt, I'm providing a Telegram link below in the description. Join in the Telegram group and you can ask me any doubt, okay, until you complete examination. Even after examination, also, you can ask me any assistance regarding a placement, everything. Okay, I will help you out. Okay, so and so do watch this MCQ video till the end, and I will be providing this PDF, and this PDF will be provided in free resources. So where can you find these free resources? In BCCA app, you can find the free resources. Okay. In that free resources, you will find this PDF and do take printout and practice these questions. And also, sir, how to prepare and what is the preparation strategy? Many a times I have already told you, you have okay only 8 to 10 hours time if you're writing both groups, and if you're writing two groups you will be preparing for 24 to 25 hours. So my suggestion is you just watch Super 50 video, and if you want to learn concept, then marathon plus Super 50, and this MCQ session will help you a lot. And in between we have a theory video also. Theory weightage is 18 marks, and do watch that video. And if you have no time to watch marathon, then at least watch Super 50 and theory and this MCQ video. These videos will help you out to get exemption, but perfection is very important. And in Super 50 also, if you have no time, at least practice a category questions, at least a category in worst case scenario. So otherwise you practice all the Super 50 questions, and students might have practiced the smart 35 also, the questions which are in addition to Super 50. Okay. And if you have any doubt, join our Telegram group. Okay, the Telegram group is created specifically for clearing the doubts in SFM. Okay, and I will help you out in that group. So thank you all. Let us start the MCQ session. Derivative analysis, the most important topic. You will get 3 MCQs from this chapter, derivative analysis. If the share of a B Limited quotes 920 on NSE and the 3 months future price quotes at rupees 950, the borrowing rate is given as 8%. The expected annual dividend yield is 15% per annum, payable before expiry. Then the price of 3 month B Limited futures would be. You know the concept of fair future price, right? How do we get fair future price? Fair future price is equal to spot price plus carrying cost minus yield. Okay. However, when dividend is given as a yield percentage, we apply the formula spot price into e power t into r minus y. R means risk-free rate of a return, y means a yield. However, we cannot apply that formula here because dividend yield is greater than the borrowing rate. Generally, a dividend yield cannot be greater than borrowing rate. So that's why in this question, even though the dividend yield wordings are dividend yield, you consider that 15% as a rate of a dividend, and that has to be applied on a face value. That has to be applied on a face value. So that's why the spot price 920 into e power, you know the concept of continuous compounding, right? 920 into e power 0.08 into 3 by 12 minus dividend amount 10 rupees into 15 percentage. Okay, so the answer is 920 into e power 0.02 minus 1.5 and e power 0.02. You know how to find out. E power 0.02 is equal to 1 plus 0.02 divided by 1 plus 0.02 square divided by 2 into 1 plus 0.02 cube divided by 3 into 2 into 1. So the answer is 937.08 is the accurate answer. But whereas the option here, the close answer is 936.9. Am I clear? Done? So be careful. And next, the second one. The stock index currently stands at 7,000. The risk-free interest rate is 8% per annum, continuously compounded. The dividend yield on the index is 4% per annum. Here the dividend yield is less than the risk-free rate of a return. So what should be the future price for a 4-month contract? Here we can apply the formula, that is e power spot price into e power t into r minus yield, dividend yield. So that's why 7,000 into e power 0.08 minus 0.04 into 4 by 12. So the answer is 7093.96. Correct option, option A. Done. Is it clear? Next, third. An investor bought 2000 shares of a X Limited for rupees 90 per share. The initial margin is 50%. The maintenance margin is 40%. If the stock price decreases to rupees 70 per share, the additional funds put by the investor to his margin account is. So, first of all, what is the initial margin? 2000 into 90 rupees per share into 50% is the initial margin, the amount to be deposited at the beginning. So, that is 90,000. Maintenance margin 40%. So, that is 2000 into 90 into 40%. So, 72,000 is the maintenance margin. So investor bought 2000 shares at 90 per share, but the stock price decreases to 70. That means he is losing money by rupees 20 per share. And what is the amount he is losing? 40,000 rupees. So the balance in margin account will be 90,000 minus 40,000, 50,000. Okay. So the balance has fallen below the maintenance margin. The maintenance margin is 72,000, but the balance in margin account is 50,000. You will get a margin call and you should bring back the balance to the initial margin. So that means the amount to be deposited, the additional funds to be put in by the investors to his margin account will be 50,000 plus 40,000. Then only the balance will become 90. It will come to the initial margin, right? So the correct answer is 40,000, but whereas in the options, correct answer is not there. So that means they are not bringing back the balance to the initial margin. They are bringing back the balance to the maintenance margin. So 50,000 is the balance in margin account, but the maintenance margin required is 72,000. So 22,000. They have considered, ICMAI has considered 22,000, but 22,000 is not the correct answer. But if in option examination, if there is 40,000, you pick 40,000. If 40,000 is not there, then you choose 22,000. Clear? Fourth one. A mutual fund wants to hedge its portfolio of a shares worth rupees 10 crores using the Nifty index futures. The contract size is 100 times the index. The index is currently quoted at 6840. The beta of the portfolio is zero point 0.8. The beta of the index may be taken as 1. What is the number of contracts to be traded? Simple, very simple. So this is the frequently asked question. Frequently, in every attempt, you will find this question. Hedging question in every attempt. You can go through the past 13 papers. You will be finding this question. So how do you get number of contracts? Portfolio value into Existing beta minus required beta divided by price of one contract. Here they are asking you to find out the number of a contracts. So they wanted to hedge the entire portfolio. That means the required beta is equal to 0. So that's why 10 crores into 0.8 divided by 100 into 6840. So 116.96 contracts. So the number of contracts to be sold 116.96. Okay. Next, the fifth one. Mr. Shan, a trader, is having in its portfolio shares worth 85 lakhs. So they are having a portfolio shares worth 85 lakhs at the current price and cash 15 lakhs. The beta of the share portfolio is 1.6. After 3 months, the price of a shares dropped by 3.2. So what is the meaning of beta share portfolio? Beta of a share portfolio 1.6. So this is nothing but if a market changes by 1, if a market changes by 1, share changes by 1.6. After 3 months, what happened to the shares? Shares dropped by 3.2. That means obviously market might have decreased by what percentage? 2%. Okay, so 3.2 divided by 1.6. If the trader on current date goes for a long position of 100 lakh Nifty future, on current date he goes for a long position. Okay, what is the value of a market index after 3 months? After 3 months, if a share drops by 3.2, that means market drops by 2%. So the value of a market index after 3 months will be 100 lakhs into 98%, that is 98 lakhs. So 98 lakhs will be the value of a market index after 3 months. Am I clear? Next, Mr. K, a portfolio manager managing a portfolio whose current market value of 1800 lakhs. It is expected that the markets are likely to correct downwards and hedging needs to be adopted using Nifty index futures. Obviously, currently index futures are quoted at 8,000 with each contract underlines 200 units. Mr. K hedges 100% of his portfolio. If the number of Nifty index contracts to be sold is 180, what will be the portfolio beta? Again, simple question. Instead of asking the number of contracts, they are asking you to find out the beta. So 180 contracts is equal to, so what is the value of a portfolio? 1800 lakhs into beta divided by value of one contract, that is 8000 into 200. So beta is equal to 1.6. Clear? So correct option A. Next, you are given the following information of a stock. Strike price rupees 400. Current stock price rupees 370. Risk free rate of interest 5%. Theoretical minimum price of European 6 months put option after 6 months is. They are asking you to find out the minimum price of a put option. I hope you remember the minimum price of a put option formula. How do we get minimum price put option? Minimum price of put option is equal to x into e power minus TRF minus what? Spot price. Here what is the x? X is equal to 400 into e power minus 0.05 into how many months? 6 months. So 6 by 12 minus spot price. What is the spot price? 370. So you will get 20.12 as an answer. You have to find out e power 0.025 value. So find out the e power 0.025 value and then you will get 20.12 as the answer. When the spot price decreases, the value of a call option decreases. When the spot price decreases, the value of a call option decreases. Okay. A stock is currently selling at rupees 270. The call option to buy the stock at rupees 265 cost rupees 12. What is the time value of a option? So time value of a option. So time value of a call option or a put option is equal to premium minus intrinsic value. Intrinsic value. How do we get intrinsic value? Here the intrinsic value means spot price minus strike price. For call option, intrinsic value means spot price minus strike price or 0, whichever is higher. Whichever is higher. So for put option, intrinsic value means strike price minus spot price or 0, whichever is higher. So here premium, what is the premium here? 12 rupees minus spot price 270 minus what? Strike price 265. So 270 minus 265, 5 rupees is the intrinsic value of a call option. Okay. So 5 or 0, whichever is higher. So 5 is higher, so obviously 5. So time value of option is equal to premium minus what? That 5 rupees. So the answer is 7. And the time value of option cannot be negative. Okay. So this is the calculation. You write down this calculation. So premium minus in bracket spot price minus X. So 12 minus 270 minus 265. So 7 rupees is the answer. Next, the spot value of a Nifty is 4430. An investor bought a 1 month Nifty 4410 call option for a premium of rupees 12. The option is he bought one Nifty for 4410, but right now the spot price is 4430. So as the expected spot price is greater than the, okay, so 4410 strike price, it is in the money. It is what? In the money. Next, 11th one. An investor is bullish about X Limited, which trades in the spot market at rupees 1150. He buys two call option contracts with 3 months. One contract is 100 shares. He buys two call option contracts. Be careful, two. With a strike price of 1195 at a premium of rupees 35 per share. 3 months later, the share is selling at rupees 1240. Net profit or loss of the investor on the position will be. Okay, investor bought two call options. What is the share price on the maturity? 1240. Strike price is 1195. So the benefit is 45 rupees minus premium paid 35. So that means 10 rupees is the benefit per one option. What is the option contract size? 100 shares. So 10 into 100, 1000. Be careful, 1000 is not the final answer because the investor has purchased two contracts. So that's why 1000 into 2, 2000 is the answer. Clear? Next one, Mr. K. An investor buys a call option contract for a premium of 150. The 42, so that is wrong one. I mean, printing mistake. If the exercise price is 45 and the current market price of the share is the current market price of a share after 3 months reaches 50, what is the profit made by the option holder on exercising the option? Contract is for 100 shares. Simple. Share price is what? 50. After share, I mean, after 3 months, share price reaches to 50. What is the strike price of 45? So obviously, the holder of call option will exercise the option, will get a benefit of 5 rupees. And how many shares? 500 shares, 500 minus premium paid. So the premium paid for one contract is 150. So the net payoff is 350. Done. Simple. Next, a call option of at a strike price of 200 is selling at a premium of 24. At what share price on maturity will it break even? Obviously 224. So strike price plus premium, and break even price of a put option will be strike price minus premium. A call option is written for a strike price of rupees 400 with a premium of 50. Here there are two correct answers. The holder will get a maximum loss of 50. Holder of a call option will get a maximum loss of 50. The writer will get a maximum gain of 50 is also a correct answer. Okay. So, but whereas in institute sources, option A was chosen as a correct answer. 15. A stock is currently sells at rupees 350. The put option to sell the stock sells at rupees 380 with a premium of 20. The time value of option will be again. So time value of option premium minus intrinsic value. Intrinsic value of a put option is equal to strike price minus spot price. Here the strike price is 380 minus spot price 350. So 30 rupees is the intrinsic value. But whereas option premium is 20, you are getting time value of option minus 10. So time value of option cannot be minus 10. So that's why we should take 0 as the answer. Okay. Be careful. 15th one. If time value of option is negative, then we should pick 0. Buying a call and put. Buying a call and put with the same expiry date on the same stock with a different strike price is strangle. Most repetitive question. Strangle. Okay. Buying call, put. Option strategies. So in descriptive general, they will not be asking questions from option strategies. They might ask you MCQ. Buying a call and put with the same expiry date and on the same stock with a different strike price is a strangle. And next, buying and selling a call and a put option with the same strike price and same expiry date is called as a straddle. How much should you be willing to pay for a put option with the same maturity and exercise price? Put call parity equation. How do you get, what is the put call parity equation? Value of a call plus present value of X is equal to value of a put plus value of a share. Value of a call 5 plus present value of a X 25 into e power 0.05 into 6 by 12. So 25 into e power minus, that is not e power 0.05, that is e power minus 0.05 into 6 by 12. That is equal to value of put plus 20. So already present value factor is given 0.9756. So 5 plus 25 into e power, so 25 into 0.9756 is equal to value of put plus 20. So value of put is equal to 9.39. Which of the following of the Greek alphabets? Greek alphabets. They're asking MCQ from Greek alphabets as well. With respect to option, measures the sensitivity of a option price with respect to time of expiry. With respect to sensitivity of option price with respect to time of expiry is theta. Is theta. Okay. So delta, it measures the sensitivity of option price with respect to the change in share price. The current price of ACC stock, risk neutralization method, they might ask you as a descriptive question also, and sometimes they are asking it as a MCQ. The current price of a stock is 1010. It is expected that the price of stock may either go up to 1212 or may go down to 808. If the stock price of a call option of A stock is 1010 and risk free rate is 6.5, the probability of decrease in stock price will be. They're asking the probability of decrease in stock price. Be careful. So one thing we can do is we can apply the formula, or else what, you form an equation. Let the probability of upper FSP is equal to P. So P into P into 1212 plus 1 minus P into 808. What is this? 1 minus P, probability of downward FSP. And the question is probability of decrease in the stock price. That means you have to find out 1 minus P is equal to what? What is the current price? 1010 into e power 0.065. E power 0.065. So what is the time period? Time period is given in the question or not? No. So let us assume 1 year. So 1010 into e power what? 0.065. So let us find out P. If you find out P, you will get 0.6625, and 1 minus P is equal to 0.3375. Here in the solution formula has been applied. Instead of applying the formula, you let us find out, you can find out e power 0.065 and find out P, and later on find out 1 minus P. Is it clear? 23rd. A company's share is currently trading at 240. After 3 months, after 6 months, the price will be either 250 with a probability of 0.8 or 220 with a probability of 0.2. European call option exists with an exercise price of 230. So expected value of a call option at a maturity date. Again, simple question. What is the strike price? Here the strike price is 230. The price may increase to 250. If it increases to 250, then the value of a call option will be 20. Value of a call option will be 20. Yes or no, they are asking you to find out the expected value of a call option. And if the price decreases to 220, then the value of a call option is equal to 0. So what is the probability of price increasing to 250.8? So the value of a call option, expected value of a call option is equal to 20 into 0.8. 16 is the answer. Done. Next, 24. The current market price of an equity share of T Limited is 500. Within a period of 3 months, the maximum and minimum price is expected to be 600 and 300 respectively. What should be the value of a 3 months call option under risk neutral method at a strike price of 550 if the risk free rate of interest is 8% per annum? So they are asking you to find out the expected value of a call option, 3 months call option. Again, let us form an equation. What is the equation? P into 600 plus 1 minus P into 300 is equal to what? Spot price. What is the spot price? 500 into e power 0.02. Why e power 0.02? Because the call option is going to expire in 3 months. Okay. So after solving this, you will get a P 0.7, 1 minus P 0.3. And what is the value of a call option? Here the question is not just the probability. They are asking you to find out the value of a call option. How do we get the value of a call option? Simple. If the price increases to 600, here the strike rate is 550. If a price increases to 600, then the value of a call option is 50. And what are the chances of price increasing to 50? 0.7. So 50 into 0.7, that is the expected value of a call option on the maturity. We should bring it to the present value divided by 1.0202. You will get 34.31. Okay, here complete solution is not provided, so be careful. So follow my explanation. Next, an option theoretical value increased by 1.75, the interest rate is decreased by 1%. Then 1.75 is the row of a put option. So this is a frequently asked question. You should understand the concept, then only you will be able to answer this. Risk neutralization. In risk neutralization, on right side, you're taking interest rate, right? On right side, you're taking interest rate. If this interest rate decreases, then right side value decreases. Yes or no? Right side value decreases. Okay. So if a right side value decreases, then what happens? An option's theoretical value increases by 1.75. If interest rate decreases, if interest rate decreases, the right side value will also decrease. If right side value decreases, then the probability of upper FSP will decrease. The probability of upper FSP decrease. Nothing but the probability of downward FSP increases. Nothing but indirectly put option value increases. So that's why it is a row of a put option. It is not a row of a call option. It is a row of a put option. What is this row? Again, row is a Greek word. It denotes the relationship between the value of an option and interest rate. Sensitivity of an option value with respect to the interest rate. Okay, if it value increases, value of an option increases, if interest rate decreases, if the value of option is increasing, then it is a row of a put option. If interest rate decreases and the value of option also decreases, then it is a row of a call option. Am I clear? If interest rate decreases and option value will also decrease, then it is a row of a call option. But here interest rate decreasing and the value of option is increasing, that means it is a row of a put option. What is the link? If you observe the risk neutralization calculation, if interest rate decreases, right side value decreases. If right side value decreases, the probability of upper FSP decreases. Nothing but probability of downward FSP increases. That means value of a put option will increase. Okay, so you just by heart this if you cannot understand now. Which of the following is not an assumption of a Black-Scholes model? Dividend is paid on the shares. Is not an assumption. Plain vanilla interest rate swap involved. Fixed to floating rate swap. Fixed to floating rate swap is called as a plain vanilla swap. Okay. So with this we have completed what? Derivative analysis. Done. Next, portfolio management. So again, this is important chapter. You will get 3 MCQs from this chapter. The probability distribution of security N is given below. Probability and return. The risk of the return of the security will be around. So risk of the return. Okay. Probability is also given. When probability is given, what are the columns? X, P, P into X, X minus X bar, P into X minus X bar square. Okay, so this is the basic question. So the answer is 7.75%. So close answer is 8%. In study material, 20% is given as the answer, but the right answer is 8%. Okay. For a portfolio containing 3 securities A, B, and C, correlation coefficient sigma AB, sigma AC, and sigma BC. All the 3 are given. Standard deviation sigma A 9, sigma B 11, sigma C 6. Weight of A 0.2, weight of a B 0.5, weight of a C 0.3. The covariance of a security A and B is. So unnecessary information is given in this question. You might get confused. Here the question is simple. Covariance of A comma B. You know the formula for sigma AB. How do we get sigma AB? Sigma AB is equal to covariance of AB divided by sigma A, sigma B. In this question, covariance of AB we have to find out. Sigma AB is already given. What is the sigma AB here? 0.4. Sigma A is given and sigma B is also given. So the covariance of AB is equal to 39.6. So option C is the correct answer. The following statement is true if R denotes the correlation coefficient. So R is equal to -1 implies full diversification of a securities in a portfolio. Full diversification. Next, M. Okay, Mrs. P is planning to construct a minimum risk portfolio. Planning to construct a minimum risk portfolio by investing in shares of N and S. The risk associated with the return of N and S are 23% and 25% respectively. If the covariance between the returns of the shares of both companies is 0, if a covariance between two companies is 0, the proportion of a fund to be invested in the shares of N Limited will be. So I hope you remember the formula. In order to find out the proportion to formulate the minimum risk portfolio, okay, when the correlation coefficient is other than -1, there are high chances that you might forget this formula. So weight of X is equal to sigma y square minus covariance of x comma y divided by sigma x square plus sigma y square minus 2 covariance of x comma y. By applying this formula, we can find out the proportion. So what is the proportion of fund to be invested in shares of N Limited? 54.16. If you have to find out the proportion of N, then you have to write sigma s square minus covariance of n comma s divided by sigma n square plus sigma s square minus 2 covariance of n s. So the answer is 54.16. Am I clear? An investor has a limited funds to invest. The following information of four securities is given below. The best security to invest if he wants more safety. More safety means he should select a security which is having a low risk. So we should select a security which is having a lower coefficient of a variation. How do we get coefficient of a variation? Standard deviation divided by mean. That is 10 divided by 12. And next 15 divided by 20. 11 divided by 70. And 12 divided by 15. So here security C is having a lower coefficient of a variation. So that's why we should select a security C. Done. Sixth one. You are given the following information: required rate of return 7%, required rate of return on a risk-free security 7, risk-free security 7, required rate of a return on a market portfolio 12%, beta of the firm 1.7, the cost of equity as per CAPM approach. The cost of equity as per CAPM approach is simple: RF plus Rm minus Rf into beta. Here Rf is equal to 7 plus Rf 12 minus Rf 7 into beta 1.7. So the answer is 15.5. So 15.5 is not given in the option. So that's why the close answer is 16.3. Next, the project X is to be financed by 40% debt and the balance with equity. If the risk-free rate is 13%, return on a market portfolio is 22%, the return from the project will be. So first we should find out the beta of a asset. How do we get beta of a asset? Overall beta of a firm. So weighted average of equity beta and debt beta. So debt beta 0, already given in the question. Even if it is not given in the question, we assume the debt beta as a 0. Okay, so 1.3 into 60% plus 0 into 40%. So 0.78. If a debt beta is given as 1% or 2%, then we take 1% or 2%. But they have clearly mentioned 0. If they are not mentioning anything, then we take 0. So 0.78. So 13% plus 0.78 into 22 minus 13. So answer is 20.02. So 20.02 is the answer. Done. Next, the project has an equity beta of 1.4 and is to be financed by a combination of 25% debt and 75% equity. Assume debt beta as 0. RF 12, RM 18, hence the required rate of return. Again, same, the answer is 18.3. Next, an investor invested 40% of her money in stock A and 60% in stock B. Stock A has a beta of 1.2 and stock B has a beta of 1.6. If the risk-free rate is 5% and expected return is 12%, find out the expected return of the investor. Simple. First, we should find out the weighted average beta, portfolio beta. So 1.2 into 4, 40% plus 1.6 into 60%, 1.44. And then RF plus RM minus RF into beta. So 15.08% is the answer. So question number 10 is not clear actually, because risk premium 2.295, market return 12%. Whether it is a security risk premium or market risk premium, it is not clear. So to match the answer, I am assuming that risk premium as a risk premium as overall market risk premium, that is RM minus RF. RM minus RF is equal to 2.295 and RM is equal to 12%. So RF is equal to 12 minus 2.295. 12 minus 2.295, you will get 9 point, I think 705 percentage. Okay, so 9.705% is the risk-free rate. So ICMA assumption is this 9.705% is the nominal rate. How do I get real rate? Real rate is equal to 1 plus nominal rate. So that is 0.09705 divided by 1 plus inflation rate 1.051. 1 plus 0.051 minus 1. Then you will get 4.38%, which is close to 4.2. So the final answer is 4.2. Okay. So this is a different kind of a question. We are taking an assumption that the given risk premium is a market risk premium, that is RM minus RF. RM minus RF is equal to 2.295, RM 12%, you are finding out RF 9.705%, and you are assuming that risk-free rate RF as a nominal rate. So again, so risk-free rate, and we are completely altogether ignoring the beta. Okay, we just remember this procedure, and this is a different kind of a question. Clear? 11th, Z Limited shares are traded in the stock market. The standard deviation of Z shares in the market are 6% and 4% respectively. If the correlation coefficient for the shares with the market is 0.8, what will be the beta coefficient of the company's shares based on a CAPM? Simple, beta is equal to sigma SM into sigma S divided by sigma M. Sigma SM is given 0.8 into 6 divided by 4. So the beta is equal to 1.2. If the covariance between the returns on a portfolio BC and returns on the market index is 25, the variance of returns on the market is 20, what will be the systematic risk of a BC under the variance approach? Systematic risk. Simple. First we should find out beta. Beta is equal to covariance of S comma M. So here the covariance of S comma M is equal to 25 divided by sigma M square. Sigma M square is 20. So the beta is equal to 1.25. So this 1.25 is not the answer because we have to follow the variance approach. So variance approach, the answer is 1.25 square. Systematic risk is equal to beta square into sigma M square. 20 square. 1.25 square into 20 square. So the answer is 20. I'm sorry, 20 because already it is a variance. So 20 into 1.25 square. So the answer would be 31.25. Clear? A firm has an asset beta 1.3, equity beta 1.5. Then which of the following is true? The firm is leveraged, obviously. If the firm is not leveraged, then asset beta must be equal to equity beta. The firm is leveraged and the debt beta is lower than the asset beta. The debt beta is lower than, obviously will be lower than the what? Asset beta. Okay. An investor owns a stock portfolio equally invested in risk-free asset and two stocks. If one of the stock has beta of 1.75 and the portfolio is as risky as the market. Here the special point is the portfolio as risky as the market. That means the portfolio beta is equal to 1. Then the beta of the stock in portfolio is, so 1, beta of portfolio 1 is equal to 0.75 because the beta of one stock is 0.75. Investment is made equally into 1 by 3 plus beta of a second stock. We don't know beta of a B into 1 by 3 plus beta of risk-free asset is always equal to what? A 0. So that's why 0. So when you solve this equation, you will get beta is equal to 2.25. Clear? So the following is not a systematic risk. Obviously, business risk is not a systematic risk. A portfolio holding 90% of its assets in CNX Nifty stock in proportion to their market capitalization and 10% treasury bill is more sensitive to systematic risk because the major portion has been invested in market. So that's why they are more sensitive to systematic risk. security A has a total risk of A and security B has a total risk of B, A is greater than B, then the following is true. A can have a lower systematic risk than B. Obviously, A may have a lower systematic risk than B. A has to have at least the same amount of systematic risk. A has to have a higher, no, A has a higher systematic risk. Which one of the following is true? Which one of the following is true? Okay, so 17D is the ICMA sources answer. Which one of the following is true? Systematic risk is independent of the industry to which a security belongs. Okay, just remember the answer. These are the answers as per ICMAI. Or a prospective investor has collected the following information pertaining to two securities A and B. Okay, so expected return, standard deviation, and beta. Variance of a returns on the market index is 225. The correlation coefficient between the return on a stock A and B is 0.75. The systematic risk of a portfolio consisting of these two securities in equal proportion is simple. First, we have to find out the portfolio beta. So, portfolio beta is equal to zero point 0.9 into half plus 1.4 into half 1.15. Systematic risk is equal to beta p square into sigma m square. Here, sigma m square is 225. So, 225 into 1.15 square, 297.56 is the answer. Am I clear? SML shows the relationship between return of the stock and beta of the stock. Return of the stock and beta of the stock. Clear? The intercept of the security market line and the y-axis is intercept of the SML on the y-axis is what is this intercept and slope? You might get this MCQ. First of all, what is this SML? SML is similar to a straight line equation. Similar to straight line equation. So y equal to a plus bx. Here x and y are variables, a and b are constants. SML, what do we write is in SML, RS, return of a security, is equal to RF plus RM minus RF into beta. In SML, beta and return of a security, these two are variables, whereas risk-free rate and RM minus RF are constants. Here RF is intercept and RM minus RF is slope. Okay, the question is intercept of the SML on the y-axis is simple. So the answer is what? RF. Okay, clear? Next, first suppose if they are asking you to find out what, so intercept on CML. Intercept on CML is also the same RF. But whereas intercept of a characteristic line will be alpha, because characteristic line is equal to alpha plus beta into x, beta into Rm. Rs is equal to alpha plus beta into Rm. Next, the slope of the security market line. The slope of the security market line denotes the risk premium required. Risk premium required. Okay. So be careful. They might ask you this question. Frequently asked questions. These are the slope of the security market line is risk premium required, whereas RF is the intercept. While plotting a graph with risk on a x-axis, that is beta on a x-axis, and expected return on a y-axis, a line drawn with coordinates 0, RF and beta, Rm is called security market line. Security market line, because beta lies on x-axis, expected return on a y-axis. Which of the following statement is are true? So first sentence, first option is true. For a characteristic line, y-axis represent return for a particular security, no doubt, because if you remember the characteristic line, RS is equal to alpha plus beta into RM. Okay, RS represents, y-axis represents the return of a particular security and x-axis represents the returns for the market index. Clear? Done. In SML, beta, x-axis represents what? Risk, beta, and y-axis represents return of a security. In all the three lines, y-axis represents return of a security. But whereas y-axis in SML, x-axis represents what? Beta, and in characteristic line, x-axis represents return for the market index. So option 1 is correct. Clear? The following is not a feature of a capital market line. Diversification can minimize the individual portfolio risk. A certain mutual fund has a return of a 17%, standard deviation 3.5, Sharpe ratio is 4, then risk-free rate is simple. Sharpe ratio is equal to RP minus RF divided by sigma. We know sigma, we know RP, and we know the Sharpe ratio. By substituting, we can find out risk-free rate. So the risk-free rate is 3%. Clear? Next, R, a portfolio manager, realized an average annual return of 15%. The beta of the portfolio is 1.2 and the standard deviation of return is 25%. The average annual return for the market index was 11%. The standard deviation of the market return is 20%. If the risk-free rate is 4%, the Sharpe ratio for the portfolio will be, Sharpe ratio simple, RP 15 minus RF 4 divided by standard deviation 25. So the answer is 0.44. The Sharpe ratio and Trainer's ratio of Reliance Growth Fund 0.56 and 9.8 respectively. The correlation coefficient between return of the fund and market index is 0.7. What is the standard deviation of the market index return? So this is the tricky question. You have to be careful. So Trainer's ratio, RP minus RF divided by beta. That means we can write RP minus RF is equal to Trainer's ratio into beta. What about Sharpe ratio formula? RP minus RF divided by sigma. You can write RP minus RF as Trainer's ratio into beta, and beta can be written as, so in question, correlation coefficient between fund and market index is given. Okay, so I can write a Trainer's ratio into sigma sm into sigma s divided by sigma m whole divided by what? Sigma s. Sigma s and sigma s will get cancelled. We know the Sharpe ratio, and Trainer's ratio into, you will be left with what? Correlation coefficient divided by sigma m. Are you getting my point? So this is the tricky one. Be careful. First, you should get an idea that Trainer's ratio is equal to RP minus RF divided by beta. You can write RP minus RF as Trainer's ratio into beta. So then Sharpe ratio is equal to RP minus RF into sigma S. Okay. So Trainer's ratio into beta. Beta can be written as sigma Sm into sigma S divided by sigma M. Then sigma S and sigma S will get cancelled. Okay. Next, the Sharpe ratio and Trainer's ratio. Sharpe ratio and Trainer's ratio respectively. The risk premium of the fund is 6%. The standard deviation of the fund return is 11.8. If the standard deviation of the market index is 9.56 and the correlation coefficient between the return of the fund and market will be simple. By using the Sharpe ratio, I can find out RP minus RF 4.366, and Trainer's ratio is already given. Using the Trainer's ratio, I can find out beta, and then beta formula sigma sm into sigma s divided by sigma m. I know sigma s, so that is 11.8, and sigma m 9.56. So I know beta, so I can find out sigma sm. So sigma sm is equal to 0.85. This is also a tricky question. Okay. Which of the following defines an efficient market? information is fully reflected in the stock prices is okay. It defines an efficient market. In a weekly efficient market, the stock price reflect the past price and a traded volume. The past price and traded volume. In the semi form of a efficient market, in the semi form of a efficient market, semi sorry, in a strong form of a efficient market, all information including inside information is reflected in price. Even an insider cannot make a profit if a efficient market is strong. Clear? So 33, the relative strength of the stock of a torrent limited. So this is the different kind of a question, is simple. So current price, what is the current price? 145.25 divided by average of all the prices. Current price divided by average of all the prices, then you will get 1.06 something. So option C is the correct answer. Nothing but, so the answer is 145.25 divided by average of all the prices, that is 125.45 plus and so on, divided by 5. Okay. So 1.06 is the answer. Relative strength of the stock. 34. The expected return from a portfolio is 16% and its variance of a return is 285. If the investor tolerance is 60, the risk penalty will be. This is the most frequently asked question. In every attempt, they are asking question about risk penalty and utility. So risk penalty simple. Variance of a return divided by investor tolerance, that is 60%. 285 divided by 285 divided by 60%, you will get 4.75%. Once again, I am repeating, this is very important. Risk penalty is equal to variance divided by investor tolerance. They might ask you as a theory question also. If a variance increases, the risk penalty will also increase, because risk penalty is equal to variance divided by investor tolerance. But if investor tolerance increases, then risk penalty decreases. In a 100 days stochastic analysis, if the closing price is 160.5 and the 100 days low and high prices 145.20 and 190 respectively, the stochastic K will be equal to. Again, this is a special question, December 24 question. Stochastic K is equal to current close minus lowest divided by highest minus lowest into 100. So that is 160.5 minus lowest 145.2 divided by highest minus lowest. So 34.15 percentage is the K, stochastic percentage. Which one of the following is not a part of market risk and why? Downgrade risk is not a part of a market risk. Downgrade risk is not a part of a market risk. If expected return of a portfolio is 15% and the variance of return is 280, and if the investor tolerance is 70, obviously risk penalty is equal to 280 divided by 70, that is 4%. 4. What will be the investor utility? Investor utility is equal to expected return minus risk penalty. So here the risk penalty is 4 and expected return is 15. So the investor utility is equal to 11 percentage. Okay, am I clear? Done. Let us start with investment decisions. Investment decisions, first MCQ. Z Limited invested rupees 20 lakhs in a project with a life 5 years and no salvage value. Tax rate is 50%, straight line depreciation is used. The uniform expected cash flow after tax and before depreciation shield are. In this question, the important point is depreciation shield. It is not a depreciation. Cash flow after tax before depreciation. Cash flow after tax before depreciation means nothing but cash flow after tax. So directly we can take a cash inflows. But here it is before depreciation shield. That means we have not yet considered the tax savings on a depreciation. So these are the cash flows before considering the tax savings on a depreciation. So in this question, this is a special point. They're asking you to find out the payback period. You know how to find out the payback period. When there are uneven cash flows, so these are the columns you have to take. Year, cash flow after tax and generally we used to take cumulative cash flow. So but here, so the special point is depreciation shield. What is the depreciation? 20 lakhs is the project cost and the life is 5 years, so depreciation is equal to 4 years, sorry, 4 lakhs, and tax savings on depreciation 2 lakhs. So cash flow after tax before depreciation shield 4 lakhs plus 2 lakhs. So 6 lakhs is the cash flow after tax. So likewise, we are finding out cash flow after tax for all the 5 years, and we are finding out cumulative cash flow. And our investment is 20 lakhs. We are able to recover our investment between 3 to, sorry, 2 to 3 years. 2 to 3 years. So that's why payback period is equal to 2 years plus 7 lakhs divided by 8 lakhs. So I know, I mean, you know the logic for this, okay? So 2 years, 11 months is the answer. 2 years, 11 months. So be careful in this question. The special point is depreciation shield. Next, question number 2. A project has a 10% discounted payback of 2 years with annual after tax cash inflow commencing from year 2 to 4 of rupees 400 lakhs. How much would have been the initial cash outlay which was fully made at the beginning of a year 1? So in this question, the special point is cash inflows are commencing from year 2. The cash flow inflows are commencing from year 2. So discounted payback period is equal to 2 years, and they are asking you to find out the initial cash outlay, nothing but project cost. Project cost. So here my answer is simple. We should bring the second year cash flows to the present value. So the project cost is equal to 400 lakhs into second year present value factor. So that is 330.58 lakhs is the cost of a project. You know that payback period means time taken for recovery of an initial investment. Here they have told that discounted payback period is equal to 2 years. That means we are able to recover our initial investment in 2 years, and second year cash flow is equal to 400 lakhs. So that means cost of a project must be equal to 400 lakhs into second year factor, that is 0.826. 330.58 lakhs is my answer. But whereas ICMAI answer is 452 lakhs. So God knows how they got this answer. So if in the options 330.58 lakhs is there, then you pick 330.58. Otherwise, what? 452 lakhs. Just remember this answer. The next third one. The following information is available in case of an investment proposal. NPV at a discount rate of 10% equal to 1250. NPV at a discount rate of 11% is equal to minus 200. So the IRR of the proposal is simple. IRR is equal to lower rate plus NPV at a lower rate divided by NPV at a lower rate minus NPV at a higher rate. So the answer is 10.86%. So option B is the correct answer. Next, fourth question. So this is also simple. It is estimated that initial cash outlay is equal to 10 lakhs. It is estimated that it will generate cash inflow of rupees 3,40,000 per annum for 4 years. The cost of a capital of the company is 5%. By how much an annual cash inflow shall change before the company becomes indifferent to the project? Company becomes indifferent to the project means NPV must be equal to 0. Indifferent, no difference. Whether you accept or reject, there should not be any difference. That means NPV must be equal to 0. So what is the change in annual cash inflows required to, okay, the project should become indifferent? Simple. First we should find out the NPV. So NPV is sum of a discounted cash inflow minus sum of a discounted cash outflow. Here NPV is equal to 2,05,640. So change in cash inflows required is equal to, so our NPV should decrease by 2,05,640. And what is the 4 years of factor? Present value annuity factor 3.546. That means we require a change in annual cash inflows by 57,992. So option A is the correct answer. Next, the fifth one. So D Limited intends to buy an equipment. Quotes are obtained for two different makes A and B as given below. Cost estimated life, ignoring the operations and maintenance cost, which will be the almost the same for A and B. Which one would be cheaper? Not chapter. Which one would be cheaper? The company's cost of a capital is 10%. Simple. When there is a life disparity, we find out equated annual cost and we select a project which is having a lower equated annual cost. How do we get equated annual cost? Sum of a discounted cash outflow divided by present value annuity factor. So here the sum of a discounted cash outflow for the project A 4.5 divided by 10 years factor 6.4146. So equated annual cost is equal to 0.732. And for project B 0.7888. So which is the cheaper one? A will be the cheaper one. Clear? And next sixth one. So Jet Limited has been evaluating investment in a project which will require 39 lakh capital expenditure on a new machinery. The company expects the capital investment to provide annual cash flow of 6 lakhs per year after taxes indefinite period. They are going to get a benefit of 6 lakhs. The discount rate which it applies to investor decisions of this nature is 14%. What will be the base case NPV? Simple. Here we are getting an inflow for indefinite period. If you're getting benefit for indefinite period, how do we get the value? Simple. Annual cash inflow divided by required return, that is 6 lakhs divided by 0.14 is the sum of a discounted cash inflow minus sum of a discounted cash outflow 39 lakhs. So the answer is 3.857. So option B is the correct answer. Option B. Am I clear? And next, the seventh one. A project of R Limited has an NPV of 1,50,000. This project has one financial side effect. It expands the firm's borrowing power by rupees 5 lakhs. The project lasts indefinitely, so it is treated as supporting perpetual debt. So the base case NPV is given. Base case NPV is given. So we have a concept of adjusted NPV. How do we get adjusted NPV? Base case NPV plus present value of a tax savings on interest. Okay, this concept I have already discussed in Super 50. So base case NPV plus present value of a tax savings on interest. Here the base case NPV is 1,50,000 plus present value of a tax savings on interest. How do we get tax savings on interest? Interest into tax rate, okay, divided by, here we are getting a benefit for indefinite period. So that means interest into tax rate divided by interest rate. So that's how we get present value of a tax savings on interest. But here we can straight away what interest divided by interest rate is nothing but what debt. So that's why other way is simple 1,50,000 base case NPV plus principal debt into tax rate. Instead of writing interest divided by interest rate, we are taking straight away debt. So debt into tax rate. Okay, am I clear? So answer is 3,25,000. Option A is the correct answer. Next, eighth one. A project of A Limited requires 30 lakhs capital investment and expects a perpetual annual cash inflow after tax of 8 lakhs. The business risk of the venture requires a 20% discount rate. However, as the project is considered socially desirable, it qualifies for an immediate tax-free government grant of 10 lakhs. What will be the adjusted NPV? Simple. Base case NPV. What is the base case NPV here? You're getting 8 lakhs benefit for indefinite period and required rate is 20%. So 8 lakhs divided by 0.2 minus 30 lakhs is the investment plus government grant. And your answer will be 20 lakhs. Option B is the correct answer. But in suggested answer, option A is given, but option B is the correct answer. Option B, 20 lakhs. Okay. And next step. A project is expected to yield an after-tax cash inflow at the end of year 2 of rupees 150 lakhs and has a cost of a capital of 10%. Inflation is expected at 3% per annum. While computing the NPV of the project, this cash flow will be taken as the following. So in capital bursting, we have our two types of a cash flows. In regular class, we have already discussed nominal cash flow, real cash flow. What is this nominal cash flow and real cash flow? Nominal cash flow includes the effect of inflation. So they are not adjusted for inflation. but real cash flows are adjusted for inflation. Adjusted for inflation means, for example, we have purchased a machinery, and that machinery is producing one pen, only one pen, and the pen cost is 100 rupees. So first year inflow 100 rupees, you're selling pen at 100 rupees, that means your inflow for first year is 100. Second year, you are producing only one pen, and in the market you are selling it at 110, your inflow is equal to 110. In third year, you are selling it for 120, your inflow is equal to 120. So 100, 110 and 120, these are called as a nominal cash inflows because these includes the effect of a inflation. Why? In reality, there is no increase in cash inflow because you are producing only one pen, only one pen. So that's why real cash flow is equal to first year 100, second year 100, third year 100. But whereas nominal cash flow 100, 110 and 120. Okay. So nominal cash inflows are brought to the present value using the nominal rate. Real cash flows are brought to the present value using the real rate. Okay. So here 150 lakhs is the nominal cash flow. To bring it to the present value, before we should bring it to, that should be adjusted for inflation. If it is adjusted for inflation, that will be called as a real cash flow. So 150 lakhs divided by 1.03 power 2, because we are receiving cash inflow at the end of a second year. 150 divided by 1.03 power 2 divided by 1.1 square, nothing but 150 divided by 1.03 square. You're converting the nominal cash flow into a real cash flow, and then you're bringing it to the present value. Are you able to understand? Okay. So 1 plus nominal rate is equal to 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. So this is frequently asked MCQ multiple choice question. They might ask you to find out the nominal rate or a real rate or a only that. They will be asking you to find out only nominal rate or a real rate. Okay. So option B is the correct answer right now. Next, R Limited wishes to earn a real rate of a 10% from its project when the inflation recorded is 7%. What is the nominal rate the company would earn? Simple, nominal rate. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation. So nominal rate is equal to 17.7. So option B is the correct answer. So clear? The next, evaluation of a risky proposal. So there are 4 investments. Which investment has the highest risk? Simple. We have to find out the coefficient of a variation. How do we get coefficient of a variation? Standard deviation divided by mean. So here mean means expected NPV. Expected NPV. Clear? So here simple coefficient of a variation. So expected, standard deviation divided by mean. So 37,947 divided by 90,000, 44,947 divided by 1,06,000, and 42,163 divided by 1 lakh, 41,997 divided by 90,000. Which investment has the highest risk? So the project which is having a higher coefficient of a variation will have a highest risk. This is a frequently asked MCQ. So here the option D is the correct answer. That means project U will have a highest risk because it is having a highest coefficient of a variation. Simple. Okay. Next is second. The following information of projects are given. If a certainty equivalent coefficient is 0.7, what will be the certain riskless cash flow of the project? Simple, first we have to do weighted average. 6,000 into 0.2 plus 16,000 into 0.8, that is equal to 14,000 is the expected cash inflow. But how do we get riskless cash flow? Riskless cash flow is equal to expected cash inflow into certainty equivalent coefficient. So certainty equivalent coefficient is equal to 0.7. So riskless cash flow 9,800. So option B is the correct answer. Okay. Third, If a project cost is equal to 12,000, annual cash flow is equal to 4,500, cost of a capital 14%, life is equal to 4 years, and present value factor 2.9137, then the sensitivity with project to the project cost is sensitivity. Okay, first we should find out NPV. So 4,500 into 2.9137 minus 12,000, NPV is equal to 1112. So what is this sensitivity? Okay, we should find out the percentage change in project cost, so that NPV should become 0. So NPV should become 0. That means the project cost should increase by 1112. So by what percentage the project cost should increase? 1112 divided by 12,000. So that is 9.27%. What is the meaning of this 9.27%? If the project cost increases by 9.27%, NPV decreases by 100%. So this is the sensitivity percentage. Next, the fourth one. So option A is the correct answer. Next, question number 4. This is also frequently asked MCQ, multiple choice question. They might ask you a descriptive question also. A project Z of Z Limited has mean NPV of 600. Mean NPV of 600. The project manager of the company wants to determine the probability of the NPV of the project under different ranges. If the standard deviation of NPV is 300, what is the probability of NPV between the range of 375 and 675? So generally G score will be given in the question. You need not worry, G score will be given in the question because you cannot by heart the G score. So how do we find out? Mean NPV 600. So they're asking you to find out the probability of NPV between the range of a 375 and 675. First you should find out the Z score. Okay. First you should find out the Z score. How do we get Z score? X minus mu divided by sigma. Mu is nothing but mean. Sigma is nothing but standard deviation. Here the standard deviation is equal to 300. So for 375, X is nothing but the value. So for 375, so Z score is equal to 375 minus 600 divided by 300, that is minus 0.17. And for 675, it is 0.25. Obviously, the lower end you will get minus, and for higher end you will get positive. So at minus 0.71, what is the value? 0.27337. And for 0.25, the value is 0.09871. So the probability of NPV between 375 and 675 is nothing but you have to take the total of these two numbers. So that is 37.21% is the answer. So the very important MCQ. So 37.21 is the answer. And next, given expected value of a profit without perfect information 1600. Without perfect information, the value of a profit 1600. Expected value of a perfect information, they are giving the value of a perfect information 300. So that means expected value of a profit with perfect information will be simple, 1600 plus 300, 1900. So that's why the value of a perfect information is equal to 300. So the answer is 1900. Next, the sixth one. P and Q are two mutually exclusive projects. P has a higher initial fixed cost and will make a profit of 10,000 for higher sales volume and loss of rupees 4,000 for a lower sales volume. For Q, the corresponding amounts would be profit of rupees 7,000 or a profit of 2,000. The probability of high sales volume is 60%. The expected value of a perfect information is simple. Expected value without perfect information 10,000 into 0.6, because that is the probability of higher sales volume. 10,000 into 0.6 minus 4,000 into 0.4. 4,400 is the profit for project P. And for project Q, 7,000 into 0.6 plus 2,000 into 0.4, that is 5,000 is the answer. Okay. So this is the expected value without perfect information. Expected profit without perfect information. For suppose if there is a perfect information, if the sales volume is high, we take a project P, and if the sales volume is low, we take a project Q, and therefore our profit will be 10,000 plus 2,000, that is 12,000 is the answer. So 12,000 is nothing but what? Expected value of a perfect information. Expected value of a with perfect information. So overall expected value of a perfect information. So there is a 60% chances of high volume and 40% chances of a low volume. So that's why expected value of a perfect information is equal 10,000 into 0.6 plus 2,000 into 0.4. So the answer is 6,800. Okay. So with this we have completed ERP and securitization theory topic. I have already covered in theory topic. Theory. You have to go through these MCQs. I need not explain these MCQs. So however, again I am discussing these MCQs. The concept of securitization is associated with debt market. Securitization who is the issuer of a securities, SPV, special purpose vehicle. Under securitization process, the bank or a financial institution which gives a loan is known as a originator. Under securitization process, dash instruments which issued subsidiary company in respect of receivables of a holding company, preferred stock certificate. Under securitization process, original borrower is known as obligor. And dash certificate under securitization have a multiple maturity structure. Pay through certificate will have a multiple maturity structure. So okay. So everybody please go through these MCQs, and I have recorded theory class also. You just go through the theory class. Next topic, security analysis. A buy signal provided by moving average analysis of stock price is when the stock price line in study metal wrong answer is given falls below a rising moving average line, but the correct answer is rising above a falling moving average line. So buy signal, when it rises above a falling moving average line, it gives a buy signal. So that is a bullish signal. But whereas B, C, and D are a bearish signals. And if the director of C Limited who has an access to insider information is unable to use this information to make supernormal profits, it is a sign of strong form of a efficient market hypothesis. What is this efficient market hypothesis? There are three forms: strong, semi form, and weak form. What is this strong form? For example, if a stock price reflects all the available information, that is publicly available information as well as the insider information and also the past trend, then that is called as a strong form of a efficient market hypothesis. That means none can make a profit. That means even insider cannot make a profit. If even an insider cannot make a profit, that is a strong form of a efficient market hypothesis. But if a stock price is reflecting only the past trend and publicly available information, then that is called as a semi-strong form of a efficient market hypothesis, because insider can make a profit. Insider can make a profit by using an insider information. Okay. A next weak form of a efficient market hypothesis means if a stock price is reflecting only the past trend but not reflecting the publicly available information, then that is called as a weak form of a efficient market hypothesis. When there is only a weak form, when there is only a weak form, then only an investor, a retail investor, can make a profit out of it. Okay. So clear. Next, third one, dash is the study and analysis of securities price movements on the following assumption. There is a basic trend in the share price movements. So this is a technical analysis. Such trend is repetitive. Share price have a little relationship with intrinsic value and are more on investor psychology and perception. So this is technical analysis. Fundamental analysis means simple share price depends upon what EPS, PE ratio, etc., etc. An event study is a test of which form of efficient market hypothesis, semi-strong form of a efficient market hypothesis. What is this event study? Event study means studying whenever the announcements have been made relating to the quarterly profits or earnings per share, etc., etc., financial results. So that is an event, that is called as a event, and that event study is a test of semi-strong form of a efficient market hypothesis. If conclusion and opinions of equity analysts and other experts based on publicly available information are reflected in stock price, then stock market exhibit semi-strong form of a efficiency. This type of a question is very important: semi-strong, weak form, and strong form of a efficiency. High growth rate in earnings and market share are characteristics of companies which are in expansion stage. Expansion stage is the correct answer, but whereas in study material, pioneering stage is given as the answer, but in MQP, model question paper, so B is given. In Porter's structure analysis, which of the following is not considered as an entry barrier? Low value addition. A business division with high growth, there is a high growth but low relative market share. It is referred to as question mark. In bull market, each peak is higher than previous peak and each bottom is higher than previous bottom, both B and C. The declining market is called bear market because of the attacking manner of a bears. According to stock market psychology, history repeats itself. Technical analysis. Violation of trend line means penetration of a trend line. Violation of a trend line means breaking through the trend line. So, I mean, that but stock movement is not following the trend. That is called as a penetration of the trend line. So, with this, we have completed security analysis. Okay. Next concept, security valuation. A stock of 10 rupees face value has declared a 35% dividend for the current year. The stock is currently selling for rupees 40. What is the dividend yield? Simple dividend yield is equal to D1 divided by P naught. That is equal to dividend 10 rupees into 35%, 3.5 divided by 40. That is 8.75% is the answer. Option B is the correct answer. Next, the current price is rupees 100. The required rate of return is 20%. The dividend paid rupees 3 on a share of rupees 10 face value. What is the expected growth rate? Expected growth rate. Simple. Required rate of a return. Required rate of a return is equal to 20%, right? So P naught price is equal to D1 divided by KE minus G. KE minus G is equal to D1 by P naught. So here KE is equal to 0.2 minus G, that is equal to 3 into 1 plus G. Be careful, here it is dividend paid. Dividend paid means D naught. So therefore after solving it, G is equal to 16.5. The close answer is 17. Okay. So 17, 16 point something. So we got greater than 16.5. The close answer is 17. So option D is the correct answer. Next, current dividend. Market price and annual dividend growth rate of the company are 2.5 per share and rupees 5 per share and 5% respectively. The capitalization rate of the equity. So K is equal to D1 by P naught plus G. So that is 2.5 into 1 plus 0.05 divided by 50 plus 0.05. 10.25 is the answer. Option D is the correct answer. Next, M Limited is expected to grow at a rate of 8% per annum, which currently pay 10 rupees as a dividend. For investment at the risk level, investor requires a return of 15% a year. What is the estimated value of a stock? Simple, P naught is equal to D1 divided by KE minus C, and D1 10 into 1 plus 0.08 divided by 0.15 minus 0.08, so 154.29. Option B is the correct answer. A stock with a dividend payout ratio of 45%, required rate of return is 15%, a constant growth rate of 10% will have a PE ratio of, it is a tricky question. So because PE ratio is equal to MPS divided by EPS. How can we write MPS, market price per share? D1 divided by KE minus G. And D1 divided by KE minus G can be written as EPS into payout ratio divided by KE minus G. And EPS and EPS will get cancelled, and the final formula is payout ratio divided by KE minus G. So PE ratio, another formula is payout ratio divided by KE minus G. Here payout ratio is equal to 45%, so 0.45 divided by 0.15 minus 0.1. So 9 times is the answer. A company with a PAT of rupees of 40 lakhs, tax rate of 50%, return on a net worth of 100%, return on a net worth 100%, reserves of 30 lakhs, par value rupees 5, will have a pre-tax EPS of rupees 40. So be careful, here it is pre-tax EPS, pre-tax. Do not get confused, okay? Pre-tax EPS. So profit after tax is 40 lakhs, right? Return on a net worth 100%. So net worth would be what? 40 lakhs, and in that 40 lakhs 30 lakhs is the reserves. That means paid up share capital will be 10 lakhs. Equity share capital, par value 5 rupees, that means number of shares 2 lakhs. Number of shares 2 lakhs. So they are asking what? Pre-tax EPS, not the post-tax EPS. So pre-tax profit 40 lakhs divided by tax rate 50%. So pre-tax profit 80 lakhs and pre-tax EPS is equal to 80 lakhs divided by 2 lakhs, that is equal to rupees 40. Option B is the correct answer. So be careful, they are asking the pre-tax EPS. Seventh, E Limited has a return on equity of 18%, a plowback ratio of 50%. Plowback ratio is nothing but retention ratio. The market capitalization rate is 13%. If the company years earnings are expected to be 4 per share, at what share, at what price E share should sell in 3 years. They're asking to find out the share price after 3 years. Nothing but P3. P3 is equal to D4 divided by KE minus G. So D4 divided by KE minus G here. So what is the dividend? So earnings are expected to be rupees 4 per share. 4 per share, expected to be 4 per share. Okay. So retention ratio 50% means payout ratio 50%. So the dividend is equal to 2 rupees. That is expected dividend. That means D1. So we have to find out D4. D4 is equal to D1 into 1 plus G, that is 1 plus 0.09 power 3. Whole divided by K is 0.13 minus 0.09. How do we get growth rate? Growth rate is equal to B into R. Here B, retention ratio 50% and return on equity is equal to 18%. So 50% into 18%, growth rate is equal to 9%. So the final answer is 64.75. Next, a 20-year maturity bond with a par value of rupees 1000 makes a semi-annual payment at a coupon rate of 8%. The YTM is 9%. How much should you pay for the bond? Simple, we should bring the future benefit to the present value. So 1 to 40 years, sorry, the maturity is 20 years, but the payment is made semi-annually. Semi-annually, so that's why I'm taking 1 hyphen 40. Instead of 1 hyphen 20, I'm taking 1 hyphen 40. So cash flow 40 and present value annuity factor 1 divided by 1.045. We should take 1.045 because yield to maturity 9%, that is per annum. For half year it is 4.5. So 1 divided by 1.045 equal to 40 times and grand total you will get 18.4. So 40 into 18.4, 736, and at the end of 40th half year you will get 1000 rupees redemption value. So the overall value is 908. And be careful, it is semi-annual payment. Semi-annual payment. So that's why we are taking interest also 1000 into 8%, 80 rupees divided by 2, 40 rupees. Next, ninth one. If the yield to maturity on a 1-year Government of India bond and a 2-year Government of India bond are 7.97 and 8.86 respectively, then the implicit 1-year forward rate at the end of year 1 each. This is the special one. You can expect this question. YTM of the 1-year bond 7.97 and YTM of the year 2 bond 8.86. So 2 years bond it is 8.86. So 1 plus YTM square 1 plus YTM 2 square must be equal to 1 plus YTM 1 plus 1 plus 1 year forward rate at the end of year 1. So this is the formula. So 1 plus 0.08886 square is equal to 1 plus 0.0797 into 1 plus F2. F2 means 1 year forward rate at the end of a year 1. Nothing but second year forward rate, second year rate. We are finding out second year rate. 1 year rate and 2 years rate are given. Nothing but we are separating second year rate from 2 years rate. So F2 is equal to 9.76%. I'm not explaining a concept here because I don't want to waste time because already these concepts we have discussed in regular class. So the forward rate at the end of first year is equal to 9.76. 10th question, all other things being equal, which one of the following bonds will have the maximum volatility? So option C is the correct answer, but whereas study material answer is 5 years 15% coupon bond. Because if maturity increases, duration increases, and if coupon rate is less, then also the duration will increase. And if duration increases, volatility increases because volatility formula is equal to duration divided by 1 plus YTM. Then obviously if a duration increases, volatility will also increase. 11th, you just purchased a 10-year maturity semi-annual coupon bond 1148.77 face value, a coupon rate of 8% and yields to maturity 6%. The bond is callable in 4 years at rupees 1040. What is the yield to call? Yield to call is same like IRR. same like yield to maturity, but we should find out yield up to the call, not till the maturity. Here bond is callable in 4 years. So that's why here the calculation is year 1 to 8, because the bond is callable in 4 years and interest is payable in half year. So that's why the coupon rate 8% is applied on face value 1000. So you will get 40 rupees, 1 to 8, 40. And at the end of 8th year, 1080, because bond is callable at 1080. Okay. So trial and error, we are using the trial and error method for finding out yield to call. At the rate of 3%, we are getting 1132. But whereas we should get, what is the price of the bond as on today? 1148. At 3%, we are getting 1132. At 2.5, we are getting 1174. At 3%, we are getting 1132. But what is the desired one? 1149. So the value has to increase. If the value has to increase, the rate has to be decreased. So that's why yield to call is equal to 2.5 plus 1174 minus 1149 divided by 1174 minus 1142 into 0.5. So the final answer is 2.8. That is per half year into 2. 5.6% is the answer. So with this, we have completed what? A security valuation. Next, Forex. They are asking a basic MCQ from Forex. You are a Forex dealer in India. Rates of rupee and pound in the international market are US dollar 0.01386952, US dollar 1.318140 respectively. What will be your direct quote of a pound to your customer? So the quote is given per rupee and pound against a dollar. So what will be the direct quote of a pound to your customer? So what is given in the question? Dollar by rupee is given and dollar by pound is given, and they are asking you to find out the direct quote of a pound. So nothing but we should find out the quote per pound against rupee. So rupee by pound is equal to. So first one we should change it. Instead of writing as dollar by rupee, we should write it as a rupee by dollar, into second one as it is dollar by pound. So dollar and dollar get cancelled and you will be getting rupee by pound, right? So that means 1 divided by 0.01386952 into 1.318140. So the answer is 95.0386. 1 pound is equal to 95.0386 rupees. So option C is the correct answer. So this concept we have already discussed in marathon and super 50 also. Second one, BLC Limited, a valued customer engaged in import business, is in need to remit euro 1 million to his European exporter. Your customer is engaged in import business and he has to remit euro 1 million. The spot rate of a rupee by US dollar is 65.47 and 65.57, and that of a US dollar by euro is dollar 0.8053, 0.8057. What rate will the banker quote to BLC Limited if the bank margin is 0.5%? Simple. Here the quotes given are rupee by dollar and next is dollar by euro. So customer has to buy euro because he is an importer. Bank has to sell euro. The relevant rate is ask rate of a euro against rupee. So we require ask rate of a rupee by euro. How do we get rupee by euro? Simple, rupee by dollar into dollar by euro. Dollar will get cancelled. Multiply both ask rates. 65.57 into 0.8057. So plus margin. So bank margin. If it is ask rate, we should add the bank margin. If it is bid rate, we should reduce the bank margin. So the answer is 53.09. Okay. Next, third. From the following quotes of a bank, determine the rate at which N can be purchased with rupees. N can be purchased with rupees. So rupee by pound is given, pound by dollar is given, and dollar by N is given. Okay. So what we require actually, we require rupee by N, because the question is at which N can be purchased with rupees. The rate at which N can be purchased with rupees. That means we require rupee by N. Rupee by N means we require rupee by pound into pound by dollar and dollar into dollar divided by, be careful, it is dollar divided by 100 N. So we write as it is, because rupee by pound into pound by dollar, pound will get cancelled. into dollar by 100n. Dollar will also get cancelled. Finally, you will be left with rupee divided by 100n. So you have to multiply with what? Determine the rate at which the n can be purchased. N can be purchased. N can be purchased means what? You have to purchase. That means bank has to sell. The relevant rate is ask rate. So that's why 75.33 into 1.565 into 1.052. So the answer is 124.35. Fourth one, an Indian invested USD 1 lakh in USA when the US dollar was 72. That means his investment is 1 lakh into 72. That is 72 lakhs is his investment. The investment has appreciated by 10%. That means 1 lakh appreciated by 10% means 1 lakh 10,000. While the US dollar has become stronger by 4%. That means the dollar value has got increased by 4% means 72 plus 4%, 74.88. The investment return in rupees. The investment return in rupees. They are asking investment return in rupees. Simple. Your investment is 1 lakh into 72, that is 72 lakhs. And what you are getting actually is 1 lakh 10,000 into 74.88. 82 lakh 63,000. Sorry, 82 lakh 36,800. So 82 lakh 36,800 minus 72 lakhs divided by 72 lakhs, 14.4% is the answer. So option C is the correct answer. Clear? Next, the spot and 3 months forward rate of US dollar in relation to a rupee R respectively. What will be the annualized premium discount with respect to ask price? Ask price. They are asking you to find out the forward discount or a premium with respect to ask price. Simple. So forward discount or a premium, how do we get it? Forward rate minus spot rate divided by spot rate into 100 into 12 divided by n. Here the forward rate is 75.05 minus 75.35 divided by 75.35 into 100 into 12 by 3. So 1.59% is the answer. It is a discount because forward rate is less than spot rate. Next, a 90-day interest rate is 1.85% in USA and 1.35% in the UK, and the current spot exchange rate is $1.6 per pound. The 90 days forward rate is, we have to apply the interest rate parity theory. So these are the frequently asked questions from Forex. They are asking from basics only. They are asking the questions from the rate to be quoted or forward rate or forward premium. That's it. So how do we get it? Simple. We apply IRPT, interest rate parity theory. Spot rate into spot rate 1.6 into 1 plus interest rate of home currency. Interest rate of home currency, that is 1 plus 0.0185, or you can consider it as an interest rate of a right side currency. 1.6 into 1 plus 0.0185 into 90 divided by 365, all divided by 1 plus 0.0135 into 90 divided by 365. So the answer is 1.6019. So the close answer is A, option A. Next, seventh one. The United States dollar is selling in India at rupees 45.2. If the interest rate for the 6 months borrowing in India is 10%, the corresponding rate in USA is 4%. What would be the rate of a forward premium or a discount? Again, the forward premium or a discount. Simple. Interest rates in India and USA are given. So we can find out the forward rate first, theoretical forward rate. How do we get theoretical forward rate? Spot rate 45.2 into 1 plus 0.1, 1 plus 0.1 into 6 by 12 divided by 1 plus 0.04 into 6 by 12. So 46.53 is the forward rate. And forward premium is equal to forward rate 46.53 minus spot rate 45.2 divided by 45.2 into 100 into 12 by 6. The answer is 5.88%. So option B is the correct answer. And next, eighth one. The following exchange market prices for US dollar against Indian rupees are quoted as under. Spot rate and 3 months forward rate are given. Calculate the cost of a forward cover. Cost of a forward cover is nothing but forward premium or a discount. So simple, 66.35 minus 65.3 divided by 65.3 into 100 into 12 by 3. 6.43 is the forward premium for buying rate. And for ask rate, it is 67.2 minus 65.5 divided by 65.5 into 12 by 3. So 10.38 is the answer. And overall the cost of forward cover is equal to 6.43 plus 10.38 divided by 2. So the accurate answer is 8.4, but accurate answer is not given in the option, so that's why the close answer is 8.22. So option D is the answer. So these are the important, you have to understand these 8 MCQs from Forex. If you can understand these 8 MCQs, you will be able to answer the question from Forex MCQ. Okay. Next topic, mutual funds. Consider the following parameters of JMB mutual funds income plan: value of investments, receivables, accrued income, other current assets, liability, accrued expenses, number of units outstanding, entry load, percentage. Mr. K wants to purchase units of the scheme. The per unit price he will pay would be NAV, net asset value. How do we get net asset value? Total assets minus outside liabilities. Here the total assets are value of investment 4169.04 plus receivables 325.76 plus accrued income 95.48 plus other current assets 962.68 minus liabilities 977.12 minus accrued expenses 225.84 divided by number of units outstanding 300 lakhs, that is equal to 14.5 is the NAV per unit. But the question is not about NAV per unit. The question is the per unit price he will pay. So obviously he should pay entry load also. So that's why issue price would be 14.5 plus 3%. 14.95 is the answer. So option B is the correct answer. Okay, clear? Next, the following information is extracted from mutual fund. A mutual fund scheme NAV on 1/11/2019 is 65.78. Annualized return is 15%. Distributions of income and capital gains were 0.50 and 0.30 per unit in the month. What is the NAV on 30/11/2019? So simple. Annualized return 15%. Okay. But the holding period is only 1 month. So holding period return is equal to 1.25. So holding period return, how do we get holding period return? NAV1 minus NAV naught plus income divided by NAV naught. So 0.0125 is equal to NAV1. We have to find it minus 65.78 plus 0.3 plus 0.5 divided by 65.78. So the answer is 65.8. So NAV at the end. So option C is the correct answer. Next. Mrs. M invested 50,000 in a mutual fund scheme. This one is tricky question. On 1/4/2022, the capital gain and dividend for the year rupees 3 per unit, which were reinvested at the year end. 31st March 2023, NAV 25 rupees. On the reinvestment date, NAV is equal to 25. M had a total units of 2800 as on 31st March 2023. At the end, M is having 2800. What was the NAV as on 1/4/2022? What was the NAV? So simple, let the X be the number of units at the beginning. So then 2800 is equal to X plus X into 3 divided by 25. So then you will get X is equal to 2500 and NAV at the beginning is equal to 50,000 divided by 2500. So 20 rupees is the NAV at the beginning. Next, fourth one. SMO mutual fund has an NAV of 8.6 at the beginning of the year. Meanwhile, fund distribute 0.8 as a dividend and 0.7 as a capital gain. If the funds return during the year is 26.6%, at the end of year, NAV will increase to. Again, the same question. We know the holding period return 26.16. So 0.2616 is equal to NAV1 minus 8.6 plus 0.8 plus 0.7 divided by 8.6. You will get NAV1 is equal to 9.35. Clear? And next, fifth question. Mrs. Rudra on 1st August 2023, during initial offer of AB Mutual Fund, invested in 10,000 units having a face value of 10 for each unit. On 31st March 2024, dividend declared and given by AB Mutual Fund was 10%, and Messrs. Rudra found that her annualized yield was 150%. What is the NAV as on 31st March 2024? Again, same question, we have to find out the NAV at the end. So, holding period return is equal to 100% because the holding period is only 8 months from August 1st August to 31st March 2024. Holding period is only 8 months. So the actual return, I mean holding period return, is equal to 100%. So 100% is equal to NAV1 minus NAV at the beginning. NAV at the beginning is equal to 10,000 into 10, 1 lakh, plus 1 lakh into 10% divided by 1 lakh. So you will get NAV1 19 rupees. NAV at the end 19 rupees. Okay, clear? You will get net asset value 1,90,000, and 1,90,000 divided by number of units at 10,000, you will get 19 rupees as an NAV. Next, the following particulars relate to mutual fund scheme. IT and ITES Limited, infrastructure, investment in shares, index on purchase date and index on valuation date is given. The outstanding number of units is 1.25 lakhs. What will be the NAV per unit? So these are the, I mean, small part of a practical questions in SFM are being asked as a MCQ, multiple choice question. So simple, ITES value 28 lakhs into 2950 divided by 1750. This already we are discussed in main questions. So 47 lakh 20,000, and what about infra? 15 lakhs into 2475 divided by 1375, 27 lakhs. And NAV is equal to 47 lakh 20,000 plus 27 lakhs divided by number of units outstanding 1 lakh 25,000. So the answer is 59.36. So option A is the correct answer. Am I clear? Next, the market price of a unit of an open-ended mutual fund scheme was rupees 30 at the beginning of the year. A dividend of rupees 3 has been paid during the year. The price of the unit is 35 at the end. The rate of a return of the past year of the unit is, this is very simple. So NAV 1 35 minus NAV not 30 plus 3 rupees dividend divided by 30. So 26.67% is the answer. Eighth one, an investor has invested in a mutual fund when the NAV was 15.5 per unit. After 90 days, NAV was rupees 14.45 per unit. NAV at the end 14.45. During the period, the investor got a cash dividend of rupees 1.35 per unit and capital gain distribution of rupees 0.2. The annualized return based on 360 days year count will be. So that is very simple. So first we should find out the holding period return, 14.45 minus 15.5 plus 1.35 dividend plus capital gain 0.2 divided by 15.5. Then you will get holding period return. Afterwards, you should convert this holding period return into annualized return. So for that, we multiply with 360 and divide with 90. So the answer is 12.92%. So option B is the correct answer. And ninth one, Messrs. B is considering an investment in a mutual fund with a 2% load. With a 2% load. As another alternative, she can also invest in a bank deposit paying 8% interest. Her investment planning period is 4 years. So either in mutual funds or bank deposit, she will be making investment for 4 years. Examine that what should be the annual rate of a return on mutual fund. Show that she prefer the investment in the fund to the investment in bank deposit. Bank deposit. This is very simple. So option number 1, depositing in bank. First, suppose if she deposit 100 rupees, 100 into 1 plus 0.08 power 4. She is going to deposit for how many years? 4 years. So 100 into 1 plus 0.08 power 4 she will get around 136. Okay, you calculate that part. So as far as I remember, that would be 136. If she has to invest in mutual funds, she should get the same 136 rupees after 4 years, yes or no? But the point is, they are asking you to find out what annual rate of a return on a mutual fund, so that she prefer the investment in the fund to the investment in bank deposit. She has to prefer investment in mutual funds over investment in bank deposit. So that means she should get the same 136 rupees. Okay. But here she is going to invest only 98. Why only 98? Because 2% is the load. Even though if she is giving 100 rupees, the mutual funds will be receiving only 98. I mean, mutual funds will be actually investing only 98 because here the load is 2%. So, how much annual rate of a return on mutual fund should be there? That we have to find. So, 98 into 1 plus r power 4, that should be equal to 136. You can try options. You will get 8.55% as the answer. Am I clear? Next, 10th one. B can earn a return of 18% by investing in equity shares on his own. On his own. Now he is considering a recently announced equity based mutual fund scheme in which initial expenses are 1% and annual recurring expenses are 2%. How much should B mutual fund earn to provide B a return of 18%? This is very simple, because R2 is equal to R1 divided by 1 minus initial expenses plus recurring expenses. Here R1 is nothing but the return which he is earning on his own. So 0.18 divided by 1 minus initial expenses 0.01 plus recurring expenses 0.02. So the answer is 20.18 percentage. Am I clear? Simple. Next, the following information is available for the mutual fund. Return, risk, beta and risk free rate is given. Trainer's ratio. Trainer's ratio is simple. Return minus risk free rate. 13 minus 10 divided by beta 0.9. Here the beta is equal to 0.9, not 9. So 13 minus 10 divided by 0.9. So 3.3 is the answer. So option C is the correct answer. With this, we have completed mutual funds MCQs, multiple choice questions. Okay.